Welcome back to Investing Talk Podcast.
Today we're looking at CleanSpark.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. The core thesis here is really about a major repositioning.
A repositioning how?
Well, CleanSpark is trying to shift its whole identity, moving from, primarily a high-growth Bitcoin miner.
Which they're very good at.
Very good at. But they're trying to become this diversified digital infrastructure platform, one that can handle next-generation AI compute.
Okay, so that pivot is really the central question for us today. Is this a genuine hedge against, Bitcoin volatility? Or are they building a true next-gen AI infrastructure company?
Exactly, because the numbers we're seeing right now, they're almost all driven by the mining side.
Right. The massive revenue growth is the starting point, but the strategy, that's the destination.
Yes, and when we talk about their core fundamentals, we have to start with the sheer scale of their execution.
The numbers are pretty staggering.
They are. For the full fiscal year 2025, revenue was quoted as $766.3 million.
Which is a 102% year-over-year increase. That's triple-digit growth.
In an industry where scaling is incredibly capital-intensive, and it wasn't just steady, was it? It was accelerating.
It really was. If you zoom in on just the fourth quarter for fiscal year 25, revenue hit $223.7 million.
Which means the growth rate actually sped up to about 150% year-over-year in that last quarter.
They were clearly hitting their stride operationally.
And that operational efficiency brings us right to the profit swing, which is a huge milestone.
From a loss to a pretty significant profit.
A material profit. They reported net income of around $364 million for fiscal 25. That's what real operating leverage looks like in this business.
Okay, but let's pause on that profitability for a second.
Yeah.
Because the trailing EBITDA margin is quoted at, an astronomical 217.6%.
Yeah.
I mean, you almost never see a number like that. How is that even possible for an infrastructure company?
That is a crucial point, and we have to add some nuance here for you. A margin over 100% in this context usually means one thing.
The value of the Bitcoin they're holding went way up.
Exactly. It means the company is reporting massive unrealized gains from their Bitcoin holdings. So the coins they mined appreciated significantly over that period.
So it's not purely a reflection of mining efficiency, it's tied to the asset price.
Right. It's a non-JAP metric, and while it's impressive, it firmly ties that profitability back to the price of Bitcoin.
Which brings us right back to why they need this strategic pivot in the first place.
Precisely. That operational foundation is what enables the pivot. Management knows that relying just on those volatile Bitcoin price cycles, it's not sustainable for a long-term valuation.
They need a more defensible advantage.
Which is where the infrastructure moat comes in. They're shifting into high-density data centers, ones optimized specifically for AI workloads.
And the key phrase here is that dual-use power footprint.
That's the entire thesis. They go out and secure massive amounts of power, which is the hardest, most time-consuming part.
Right.
And then they essentially have a toggle switch. They can direct that power to whatever offers the highest return at that moment.
High-margin AI hosting or their core Bitcoin mining.
Exactly. And the facility design for advanced Bitcoin mining is often very similar to what's needed for high-density AI compute.
You're talking about massive power, advanced cooling, all that stuff.
All of it. So the underlying infrastructure, the building, the power contract, it's fungible. They can transition capacity over time as AI contracts come in.
And this isn't just a strategy on paper. They're making huge commitments in Texas.
Absolutely. This is anchored physically in their Texas expansion. They acquired rights to 271 acres in Austin County.
And more importantly, they secured long-term power agreements for 285 megawatts.
And to put 285 megawatts in context for you, that's enough power for a decent-sized city. This is a material pivot into large-scale digital infrastructure.
It's a completely different asset class thesis.
And they're backing it up with people, too. They hired an industry veteran, Jeffrey Thomas, as their SVP of AI data centers.
Why does a single hire like that matter so much?
It signals serious commitment. You don't bring in a recognized name for a specific role like that unless you're dead serious about shifting capital and focus. It tells the market this isn't just AI hype.
It's a foundational change.
It is.
Okay, shifting to the balance sheet. How are they funding all of this? You'd expect a company growing this fast to be loaded with debt.
But they're not. And that's a massive strength. They maintain a very low debt posture.
Even with total assets over $3 billion now.
Right. Their debt-to-equity ratio is only 0.38. That's very prudent. It gives them a huge amount of financial cushion and flexibility.
And that strength is what allowed them to go out and raise that massive war chest recently.
The $1.15 billion raise.
Right.
That's right. They completed a private offering of 0% convertible senior notes,
Let's break that down. 0% means no interest payments.
which is incredibly advantageous. And convertible means the debt can be converted into company shares later on at a set price.
But the risk for shareholders is potential dilution down the road.
It is, but the upside for the company is that the money is explicitly aimed at accelerating the strategy. Data center land, power agreements, AI initiatives, it's all going straight into building that moat.
And while they're doing all this, we can't forget they're still relentless miners,
Not at all. They just surpassed 50 exahash per second of self-operated capacity.
which is an industry first.
It is 50 quintillion attempts per second to find the next Bitcoin block. That kind of scale shows they can execute on their core business while building for the future.
Okay, so the fundamentals are strong. Let's move to the technicals and what the market thinks. How has the stock reacted to all this?
The price action has been strongly bullish. The stock recently hit a new 52-week high around $22.12.
It's in a pretty clear uptrend.
A sustained uptrend. Higher lows, higher highs. It suggests that, the big institutional money is accumulating the stock.
And it seems like market perception is catching up. They're being included in those AI infrastructure conversations more and more.
That's right. Institutional ownership is robust. The market clearly sees them as a high-quality play on both crypto and digital infrastructure.
And the analyst consensus reflects that too.
Overwhelmingly positive. The average analyst price target is around $23.83, with the high estimate reaching all the way up to $30.
So the street believes there's still significant upside here.
They do, especially if the AI pivot executes successfully.
Okay, that was a lot of bullishness. Let's inject some skepticism. We have to address the short-term concern, which was the fiscal year 2025 results.
Right.
The growth was massive, yes, but they did modestly miss consensus expectations.
They did, and that miss caused some short-term volatility, some negative chatter online. That's just unavoidable with high-growth stocks like this.
So how do you frame that risk?
Well, I'd argue that when a company delivers 102% growth and a huge profit swing, the miss is less about a fundamental weakness.
And more about expectations just getting a little ahead of reality.
Exactly. But the long-term risk is still there. They've raised the capital, but now they have to execute flawlessly on this transition.
What if those big AI contracts don't materialize quickly?
That's the question. They need to prove this dual-use footprint can actually generate revenue from the AI side and isn't just an expensive backup plan. Investors have to be ready for some volatility here.
So looking ahead, say the next 3 to 6 months, what are the key catalysts we should all be watching for?
The first big one is the Q1 2026 earnings release. That should be in January.
And what are you looking for in that report?
Early, measurable progress on the Texas data center ramp-up. Are they installing AI racks? Are they talking to cloud providers? Is there any, and I mean any, revenue contribution from AI hosting yet?
And outside of the official earnings numbers?
The news flow is huge. Any announcement of a new AI partnership or, the dream scenario.
A major hosting contract.
A major contract with a big cloud provider. If they announce a Tier 1 customer signing a multi-year deal for that Texas capacity, that instantly revalues the entire company.
It would decouple them from being just a pure play miner.
Massively.
Wow.
And finally, we need to see how they're deploying that $1.15 billion. We need updates on acquisitions confirming they're putting that capital to work, not just sitting on it.
So it's an interesting setup. It seems attractive for short-term traders playing these catalysts, but also for long-term investors if you believe in the digital infrastructure story.
It really is both.
I think the most compelling factor here isn't even the 102% growth. It's the long-term option value they're building into their power contracts.
The flexibility.
Exactly. The ability to pivot that massive power capacity instantly between Bitcoin mining and high-margin AI workloads. That's what sets them apart.
That optionality is how they could transition from being a cyclical commodity stock to something more like a foundational infrastructure utility. And the real question for you to think about is this. If they manage to sign just one major cloud provider contract, what kind of valuation multiple does the market assign to that now dual-purpose 285 megawatt facility in Texas? It's a completely different ballgame.
That is a fantastic thought to leave you with. Make sure you subscribe for more analysis of the companies driving the future of digital infrastructure.